Well, today is an absolutely outstanding day. John Rubino is with us today. We are going to talk about one of my greatest fears, and I think we are tremendously overvalued in my asset class, real estate. And we've been seeing this in commercial. We've been hearing these horror stories about, you know, multifamily and office towers that are really um, just when they come up for refinance, they're plummeting in value. Lenders are taking money, and I think this is about ready to spill over into Main Street America, into the housing market. And John, you are the perfect guy to talk to. I've been so excited to talk to you because I think you, of all people, are going to be able to have some solutions. So, John Rubino, thank you so very, very much going on. What do you think is going on today? And just a kind of a broad stroke as to what's, you know, I thought that we were going to enter into recession Q4 of 2023. Here we are a whole year later. We really haven't gotten that, but we might talk about some things as to why we extended that. What's your outlook for the next 6 months to 12 months, John?
Hey, Michael. Well, I've been talking about a recession as imminent for quite a while, too. It's at least 2 years that I've been saying, oh, my God, look at what's happening with credit cards and look what's happening with commercial real estate and home prices and the savings rate. Actually, I do a once a month recession watch post on Substack. And there's never a shortage of graphs and charts that look just hair-raising, that clearly point to a rollover in the economy and a bear market and in equities and all of that stuff. And it hasn't happened yet. And I think the main reason that it has not happened yet is that the government is preemptively running crisis level deficits. If you create $2 trillion out of thin air, dump it into the economy, somebody gets that money and somebody spends it, right? And so the economy continues to grow. But that's not a sustainable plan. That's the kind of thing you do in a crisis. You get through the crisis and then you deal with the consequences of the excesses of what you did during the crisis. And, we've been doing this since the beginning of the pandemic. We've been in a crisis in terms of government spending and deficits. So, take it. Yeah, well, go ahead.
Even if we're wasting the money, because we're hearing these horrendous things that they're finding, we're just squandering these funds, but it gets money into the system. So even if it's not good money or good investment, malinvested money, it's still putting money into it, and there is a velocity of money that happens. And my concern, John, is that this is going to get turned off.
Well, I mean, it always does eventually. And what we're doing right now with the Doge thing and cutting government spending as aggressive, or government employment as aggressively as they can get away with, that's a contractionary thing. And you've got Trump out there talking about cutting military spending in concert with China and Russia, which would be the best thing in the world. I mean, if he does that, he's Winston Churchill, as far as I'm concerned. If we can scale back the global military empire, that gives us a chance of surviving in our current state intact without, having the system just collapse across the board. So. And the money supply is no longer growing super aggressively like it did. M2 spiked during and M1, all the monetary aggregates spiked during the pandemic when we were just shoveling money out the door. And now the Fed's balance sheet is back to shrinking a little bit, and the money supply growth has moderated. It's still not falling. It fell for a little while, but now it's growing very gently. And so those are kind of slow down indicators. And I think at some point that bites. What the catalyst is impossible to predict, because there's like 8 different things that could be the catalyst for the next big financial crisis. But I think a lot of them are in your space in real estate. When you look at what's happening with office buildings, for instance, even though a lot of companies and the government are calling people back to work, you still have low occupancy rates in a lot of office buildings. They've been financed or built with incredibly cheap money in the past decade. And so when it comes time to refinance them, they're not worth anything like what they have to be worth to be refinanced at today's higher interest rates. So a lot of these buildings are changing hands at extremely depressed prices, which means there's an embedded loss there somewhere. A lot of those embedded losses are in local and regional banks who are going to have to report those losses, which is going to spook the depositors into pulling their money out, which is going to cause bank runs, and then a banking crisis. That's one catalyst, but it's a very that's a catalyst with a very clear step-by-step projection. Other things being equal, like if nothing else blows up, you'd expect that to happen. But then you've got, oh, go ahead.
No, I just want to mirror what you're saying. This has been my concern: is what is the true value of the real estate? You know what? When you start, you went right to it, John. Thank you very much for that. When you start looking at an office building or multifamily, and you're looking at what they are sold on income, what does this property produce? And when they start losing the vacancy, because vacancy factor is the highest in history. When you say it's the highest in history, it means like it's never ever been this high before. And you get valuations, and you start talking about, there's such a concept as the infinite returns. And I'm sure you're aware of that, where you buy a building, buy a big office building or a multifamily, you do a little bit of improvements, you get it reappraised, you take more money out, you get it appraised at a higher rate, you take all of your cash out, and then you put all that liability onto the lender, because the investors have all their money out on the refinance. And then if you have some kind of a change in fortunes, who's stuck with all the risk and the liability is the new lender.
Mm-hmm.
And who has been in the news here in just the last couple of months was Warren Buffett. And what is he selling with his finger on the sell button is the banks.
Yeah, he sold a ton of Bank of America and Wells Fargo just lately, and which makes sense. I mean, if you're towards the end of a cycle, the banks are going to have trouble going forward, even if you don't know exactly how specifically they're going to have trouble. They own assets, they have loans outstanding. People owe them money. In a recession, fewer people pay back their loans, and the banks suffer.
Correct.
So, and then derivatives, let's not even go there, because it's just too crazy when you start thinking about the numbers in the derivatives market. That could blow up again very easily. So yeah, actually, it's funny. My son is a little bit of a day trader, and he just shorted J.P. Morgan Chase and Wells Fargo like a week and a half ago, and they're down since then. So I think he's pretty happy with his put options on those guys. But yeah. Warren Buffett is a pretty good indicator of where we're going, and he has raised more cash in the last couple of years than ever before. Normally what he does is, he buys things, they go up, he sells them towards the peak of the business cycle, goes to cash, and then buys maybe the same assets again at the bottom of the next cycle. Well, he's in the aggressive selling part of this process.
Yes.
And, if you just use him as an indicator, it's been a pretty good indicator of where we're headed as an economy. When his cash pile gets really big, we get a recession. And his cash pile has never been close to this big before. This is the most cash he's ever raised.
Well, this is right. I've been in business for almost 50 years, and this is so reminiscent of 2007. Here in Maricopa County, Phoenix, we had nothing. We had the mantra that there was nothing to buy, and affordability was off the charts. There was nothing affordable. And that's just very similar to what we have. Nothing is affordable. And when we start looking at what is affordable, here's one of my concerns, John. What is this worth? What's the value of real estate? Now, we're hearing these things. Now, if you listen to Melody Wright, which I think you probably know who she is. I mean, she's just an absolute great with her statistics. She's talking about pure 90-day delinquency on FHA is over 7%. And it was over 7% in 2007 when we started cratering, and we're just getting started now. I'm hearing that we've got delinquency, which is just like 30 days plus, at over 12% on FHA, which takes us right back to who's going to end up with all these properties is the lenders.
Mm-hmm. And they really don't want that to happen. Like banks hate having a big real estate portfolio. So I mean, on the one hand, this is kind of an obvious thing because it's part of a cycle that recurs over and over. You know, you've had real estate busts going all the way back to the beginning of financial statistic recording. It's just an easy industry because houses are financed and buildings are financed. When leverage is available, it's really easy to overdo it in real estate. And we've seen an epic bout of overdoing it in this. And it's not that there are so many houses being bought at crazy high prices. It's that there are any houses being bought at these prices that guarantees a bust at some point. Because like you said, affordability is it's evaporated. You know, the average person can't even come close to buying the average house. Did you see the chart that's going around on the average age of home buyers in the US? Well, it used to be late 20s, early 30s. That's the normal time when the majority of people are able to buy houses. Now it's all the way up into the high 50s. So a typical home buyer in the US is 56 years old. And the reason for that is because you got to be way into your career path before you have the money to buy today's houses because they're so expensive. So that's, first of all, it's screwing over young people badly, you know, when you inflate real estate this way. And it's also creating the conditions where the guys who are buying houses now, you know, they're going to want to downsize or retire shortly. And there's going to be nobody left to buy their houses. You know, they will be stuck with unsellable at the current price real estate that they have to cut dramatically. And so, again, timing, obviously hard to predict since I've been predicting a recession for 2 years. But at some point, so much new real estate comes onto the market at today's price, doesn't sell, and then the price cutting starts. And then you get your housing downturn. And, you know, inventory is already spiking in a lot of places. So that's stage one. Sales. Okay. Stage one is sales dry up. Stage two is inventory of homes for sale starts to spike. Stage three is price cuts. And we're just heading into stage three. And
let's explore that, John.
Yeah.
So we have a whole generation. Well, I shouldn't say generation. Maybe that's a little bit too much. If you bought your house from 20 to like 23, you probably are frozen. It's called the frozen homeowners. They've got a 2.5%, a 3%, a 3.5%, or a 4% mortgage. They're not selling. Their house payment's $1,500 in order to replace that. They're looking at $3,100, $3,200. They're not selling, but the market is still active. So who is it? You've already said this. Who is it that's selling these properties? Is the people who have to sell, correct?
Yes. And there are three groups of people that are all going to have to sell on a massive scale pretty soon. First is boomers, obviously. You know, we're in the stage of retirement now where you know, a 4-bedroom, 4,000 square foot house on 3 levels just isn't impossible because of our knees and our hips, right? And the yard work, you know, well, on a 1 acre lot. Yeah. So we got to sell, or we have to invite the kids and the grandkids to come live with us, which is happening in some cases. And I think is pretty healthy, all things considered, because that's the way humanity did it for the first 10,750 years of history. And only in the last 100 years has it been this kind of atomization where everybody, as soon as they can move out, they go move to the other end of the country and you're all spread out and everything. And I think economics is forcing a reversal of that trend. Okay, so boomers start selling their McMansions. One other group is the Airbnb guys who built these empires of condos and houses for rent and things like that over the last 10 years with cheap money. Those things are not nearly generating the kind of cash flow they need to pay off the related
no longer
debt.
viable.
Yeah. Airbnb income is unreliable, and in part because it's so expensive now. Airbnbs have gotten as expensive as hotels, and in a lot of ways, way more complex than hotels. You know, you got to clean the place before you leave to really exacting specifications. Who wants to do that? The nice thing about a hotel is somebody takes care of everything for you. So Airbnbs are never my first choice when I'm traveling. And so in that sense, the market isn't what it once was. So those guys are going to have to dump their empires, their 17 condo empires and 22
Right.
house, excuse me. And that is and in a lot of cases, those things are in hot markets, places where people expected to be able to rent out their Airbnbs for a fortune.
Yeah, we're seeing that in Scottsdale. People went, if one was good, five's got to be better, 10 is going to be terrific, and 20 it's a home run. And of course, now that all that liquidity from the PPP and the stimmy checks is gone. I mean, you've already alluded to it, that people are tapped out, their credit cards are maxed out, their savings is at historic lows. They haven't got the money to do this. What's the other one, John, that you think? There's another group that I know is going to be doing this very soon.
The last and maybe the best group is Wall Street, because for the last 10 years, private equity companies have been buying up whole neighborhoods at 20% over asking,
Yes, they were.
Yes, they literally did that.
When you raise the price, when you pay too much.
Yeah. And so now the return on those houses that they're renting out is dropping.
Correct.
And real estate has no, long-term commitment to an industry. It just chases hot assets and then bails out. So I think, we're going to see the private equity guys just bail on a vast scale here pretty soon. So, the ones where they bought whole neighborhoods, they're going to be selling whole neighborhoods, or in other words, by marking them down below comps, neighboring comps, just to clear out the inventory. And so you put those three things together, and you've got, on the one hand, you've got mass bankruptcies among the banks who lent the money and the hedge funds
and the bondholders.
And the bondholders. Everybody who's associated with this process has to take these big losses, and some of them will find that they're fatal. Prices will tank, of course, because that's how you flush out all this inventory, and inventory itself will spike. So in other words, you get a garden variety real estate bust here. It could be made much worse, because those three categories of homeowners have never been there together before. There's never been an Airbnb situation like this. Certainly never been Wall Street landlords in the business this way. And the baby boomers have never retired before. Correct. So you put all this together, and the potential is there for this avalanche of inventory to hit the market. And you know what? I'd love to see that. Oh, I don't want bad things to happen to the people who are in the market, but as somebody who might want to buy some real estate, like I have a self-directed IRA that lets me buy real estate if I want to. But the problem is you can't buy it and use it yourself. It has to be arm's length. As an investment. So I can't buy my kid a house with that account or anything. So I don't know what to do with it, but I'll buy a rental house or some other investment property after they tank by 50 or 60% from here. So from just my point of view, it would be pretty cool if all of this happened, because I finally get to use that account that's just sitting there.
Well, my charts are showing, here's the things that concern me. In my business, my charts are showing we've got a huge retracement coming all the way back to 2020, which is pretty scary. So you've already hit upon this. Who sets the value of these properties? If you've got a frozen group that's probably 40 or 50%, if you recall, it's comps. It's what the last three in your neighborhood sell for. That's what sets the price. And if the last three in your neighborhood that sold were someone that had 80,000 units and they're now selling their portfolio, and they're selling it, as you mentioned, below market to get it sold because it's sitting there vacant and they want to get it sold. And so if it's worth 100%, maybe they're going to sell it for 95% or 90%. And everybody thinks, well, that's a great deal. And so now the comps are 10% below what they were, because that's the latest comp. And if you want to sell it, you need to sell it for 10% below that one is. And that great pressure, and is it going up, is the same pressure you get when it's coming down. And I see that, John. I see that happening, because I think the people who are going to set the comps are the people who need to sell. And when you need to sell, you need to sell for what you've got. Or they've got $150,000 in equity. They were an FHA buyer. They put 3% down. They put $25,000 or $30,000 down, and you got $150,000 in equity, and you want to capture that. So I see the selling pressure comes just as what you're describing, and it really concerns me because I think it's going to be vicious.
So Michael, you're actually literally seeing that now in the Scottsdale area, where there's kind of panic selling starting to happen.
Not Scottsdale. Scottsdale is it's a bifurcated marketplace. It's Scottsdale with the golf courses and the gated guard gates and roving guards. People are coming in and buying these properties, but they're paying cash because they have no problem doing that. But we are seeing this in the lower ends, the affordable, where most of my portfolio is in the affordable housing space. These people are struggling. And here's the other thing that concerns me, John, is that the builders are looking to sell their property. They want to get out of that land bank. That land bank is an alligator for them. It doesn't make them any money, and they have to pay every month on this vacant land that's doing nothing. They got to build it. The only way out is to build it out. So they're selling these properties. They're not making a lot of money on them, and they're giving concessions like crazy. So we're hearing $25,000 concessions, $40,000 concessions. I'm hearing even not so much in my marketplace because, Phoenix has got all the chip manufacturers coming here. We're getting a lot of people coming in, so it's really picking up. But other places in the country, they're talking about $100,000 in concession. So my question, John, is if you have $100,000 in concessions, what's the house worth? Are you buying a $600,000 house for $700,000? Because that's the net effect of concessions, are they not? Because if you had to sell it the next day, those concessions are gone.
Actually, the concessions thing it reminds us that there's actually another category of sellers that might be involved in this, and that's the home builders, right?
Yeah.
Because they are managing to move their inventory. They've got all this raw land. They've got to build on that raw land. Otherwise it eats them alive. But to sell the houses at today's prices, they've got to offer concessions. So a home builder might offer you a 3% or 3.5% mortgage on the house, which makes it a lot more attractive when mortgages are 6 or 7%. But the home builder has to eat the differential, unless they can borrow for way less than that interest rate. And so they're building in a lot of losses in order to move inventory right now. And that can't go on forever. They've got to move that raw land that they bought. So they've got to build an X number of houses. And so that has to come on the market no matter what the market is like. So, everywhere you look, there's excess inventory. And this has the feel of something, it's not exactly the same as 2005, 2006, 2007, because we were building a excess number of houses then. There were more houses than the population can absorb. And that's not the case anymore. But back then, prices weren't nearly as high as they are today. So those two things kind of offset each other. Houses are much more unaffordable now than they were.
Correct. It's an affordability crisis. There's plenty of demand. People just can't afford it, which takes me back to when we start doing just our basic metrics. This is what really concerns me, is that when we're looking, we have properties in our portfolio that if we were to sell those properties, we're renting them for like $1,800 a month, $2,000 a month, $2,200 a month. But if you were going to buy that exact home, you'd be looking at paying $3,200, $3,300 for the same house you can rent for $2,200 or $2,000. And that's a huge disconnect. So and that's just the easy metric that they've used for years, just the, rent to own. Rent payment should equal housing payment. That has been like that for 50 years. Now they don't, they vary up and down. Sometimes one's richer than the other, but they're out of whack by like 30%. 30%, John.
Well, Michael, rent should be higher. Wait, let me think about this. Yeah, rent should be higher than the purchase cost of a house because the person who owns the house has to turn a profit, right? So they're going to buy the house, pay what it takes to own the house, and they need to charge more than that for rent in order to have positive cash flow. Correct. So when rents are way below the purchase cost of a house, that seems like you're building in a lot of losses there. The bankruptcies will come. It's just not clear where and in what order. But a lot of those people can't make make a long-term profit in that
No,
kind of a situation.
no. And this is where we get where we have problems with our valuation, is because if we just look at housing and we say, well, what's the direction of the value of housing? And we say, well, there's a whole group that's not selling, and the ones that are selling are forced to sell, and the forced to sell are driving prices down because they're setting the new comps. Then if we take those same houses that I rent and we use a cap rate and say, well, exactly what you're alluding to is that I buy this property for a return. And when we had cap rates, we've had a cap rate here in Maricopa County running right around 4.5% for 10 years, and the alternative investments were you could get a 10-year treasury bond for 1.5% for 10 years or 2.5% for 10 years. I mean, it got down to 0.62% in November of 2020. So a 4.5% return sounded pretty doggone good. Plus throw in a little tax savings and a little capital gains and appreciation was a very, very nice return. But now the world has changed, and you can put your money into almost a risk-free government money market and get 4.5 or 4.6%, better than what I get taking risk. So what then becomes the new cap rate? For you to take a risk, are you going to do it the same cap rate that you can get with a T-bond or just a money market? That you got check writing, you take your money in and out of every day if you want. You're probably going to want a higher return on your money in order to do that, correct?
Yes. Yeah. And so what happens when you can't get that? Which is kind of where we are right now. We got a business that doesn't work anymore.
Correct.
And markets, the purpose of markets is to make those adjustments.
Correct.
And the adjustment that the market would make now is house prices have to come down or interest rates have to plunge. The cost of buying a house with leverage has to go way, way down. So, it could be that the economy tips into recession, the government cuts interest rates like crazy, and we're back to 0% interest rates. And then houses at this price might be justifiable because you're only paying, 2.5% on your mortgage or whatever. But something like that has to happen. And there's no real way to get from here to there without it being brutal for somebody. Some
Correct.
category of people is going to have to suffer very, very badly to balance this equation. And
100%. Every way I look, John, everywhere I look, every metric I look, we're overvalued, and some places severely overvalued to the point where all this, it's kind of when we think of the trillions and trillions and trillions, literally about $17 trillion of liquidity that was put in after the great financial crisis. My gosh, it might have been over $20 trillion, John, and created an artificial asset class. And I think you can roll that over into the equities market as well, and certainly into mine. And I think that needs to be resolved. It's really a concern for me. And so when we do the metrics and just raise the cap rates up, so we went from 4.5 to 5. Maybe we go, during the great financial crisis, my portfolio, the cap rate was between 6 and 8%. That was just standard. No one blinked an eye getting 6 to 8% cap rate, and we're down to 4.5. So if it went to 6, a $400,000 home in our portfolio would go down to $280,000. That's brutal, John.
Yeah, but I can't help smiling because that's what I want to look for with my self-directed IRA. Something that just did that, dropped from 400 and some to 200 and some. Yeah.
I think that's coming, John. I've been doing these valuations. That's why I wanted to talk to you to get some validation. If you're on the same page, I'm going to feel a lot better. But that's what we're looking at.
Well, I'm definitely on the same page, but with the proviso that my timing is really bad. I've been predicting this for quite a while. So, you can't count on me to to justify any kind of a trade that's time sensitive, because, if I'm already off by 2 years, I might be off by 2 more years. But, the general trend, like the directional part of the story, guaranteed. There's no way that we don't have a big adjustment in the real estate market at some point soon.
Well, then I've been telling people, my clients, that we've been on a moratorium for a couple of years. We're not putting any new capital in. We're doing 1031 exchanges, of course. We're just moving from one location to another location. What's going on here in Phoenix, John, it's just unbelievable. It's when I tell people what's going on here, they just don't believe me. It's really awesome. So we've been doing a lot of that, but we have not been putting new capital on. So I don't think here, even in Phoenix, we're going to be immune from this. But I do see it's dropping. And what you alluded to in the great financial crisis, they did drop rates just like now. If you look into 2007, the affordability was very similar to what we see here. And we saw interest rates spike just like we did here. And then they lowered the interest rates, I think went down to the Fed rate went down to 0.25%. But what happened, John, was that people were out of work. They couldn't afford these. They lost their jobs. They couldn't get. Who's going to give a mortgage to someone who's laid off? It's not going to happen. So this is what I'm concerned about.
Yeah. Hey, so you're saying Phoenix is booming right now, right? Is that what you were?
Yes.
Lots of people are moving in.
We have a lot of people moving in. So there's a new CHIP Act, U.S. CHIP Act. Phoenix received the Taiwan Semiconductor plant. It originally came here as an $8 billion plant, a really big deal, $8 billion. Yeah. It's now a $66 billion plant. And they're bringing in thousands and thousands and thousands. And chip manufacturers are now building plants to support the chip manufacturer.
So, okay, but my question is, where does the water come from all this? That seems like the sticking point in the Southwest.
We're using less water now than we did in 1958 when they started doing this. And that's because agriculture took so much water. And our agriculture has come down. We have water like crazy. These plants, of course, recycle their water. And we have dams. If you come here, John, you want to go fishing in lake. The lakes we have are just unbelievable. But the groundwater, we don't really have a water problem. We're using less than what we did before. So
yeah, I did a post a while ago on Substack about whether desalination would save the Southwest. And so I researched it and looked at interviews with people who are experts, and the conclusion that seems to be the most logical is that no, desalination is still too expensive. But if you close down a bunch of the agriculture where people are irrigating the desert, then you have plenty of water. Yeah. So that sounds like what you're doing. What higher value stuff is coming in and displacing heavy water using industries like agriculture, and that makes it possible to continue to grow in a place like Phoenix. Okay.
Yeah, so that's what's been happening, and I can't say that everywhere in Arizona is that way, but Phoenix is just doing really well. We just got the Taiwan Semiconductors. We've got the F-35 wing for Luke Air Force Base. The BNSF Railroad is just bought in. They're bringing $1 billion firms. We've got if Wall Street Journal did a documentary on the truck route where they're bringing in, it's the new Inland Empire. And, I have a lot of clients in Silicon Valley. They are finding that people in Arizona are just as smart as they are in Silicon Valley. And it costs them like 25% of what it would cost you to do it there. So it's good, but we're not booming because this is still coming, and we did the U.S. CHIP Act with Intel. Is now emerging with Taiwan Semiconductor, and it's got the blessings of the Trump administration. So we're looking good here, John. But I don't think we're going to be immune. I think we're going to resolve. I think we need to correct.
Okay. All right. Good. That makes sense because a lot of the spending you're talking about is long term.
Correct.
And the housing market is short term right now. It's very much at risk. So yeah, so there could easily be a housing bust in a booming city, if the timing of the the boom and the bust aren't synchronized. So yeah, okay, I can see that happening down there.
Yeah, I'm really bullish 3 years out, but at the moment I'm waiting for this what I'm calling it a waterfall effect where it really corrects.
Mm-hmm.
Well, John, thank you so very much. Thank you. I've really been concerned about this, and I knew if I talk with you, you could give me some clarity on this. And thank you, you did. What else are you seeing, John? We'll wrap this up a little bit. We've been in here long. I've taken away an awful lot of your time here today. I appreciate you giving me your time.
Well, there's all kinds of wild stuff going on out in the world right now. So we could spend the rest of the day talking about highly unusual things that are happening. But I think, from my point of view, the precious metal story is pretty interesting right now, because gold seems to be, although it's getting whacked today as we speak, it's had a really nice run. And a lot of that is independent of the business cycle. It's central banks who have decided that the currency system is going to have to be reset, and they want gold as their base money. And so you see a lot of big entities like that buying a lot of precious metals. And I think that's going to start bleeding over into the mining stocks now as a category, because if you're a gold miner and the price of what you're digging out of the ground goes up by 50%, your revenues go up by 50%. And then you control your costs, and your earnings go up by 300%. A lot of miners are seeing stuff like that. So they're becoming growth stocks. So I think that's an interesting play, something I'm paying a lot of attention to now.
Well, that was on your Substack. You sent that out. I get your Substack every time you send it out. I get that, and you've been 100%. You've done very well with that. What do you think of what's going on with the London sending their gold over here?
Well, that's part of a big complex story, but I think the London thing started because of Trump threatening tariffs against Europe. And everybody who has gold stored outside of their country wants to bring that gold back so they don't get hit with tariffs when they eventually try to move it. So that sparked a lot of gold demand in London from entities in New York. So a lot of gold got shifted back. And then came the Trump and Elon Musk idea to go, visit and maybe audit Fort Knox to see if the gold is really there. So it could be that a lot of the wild stuff that's happening with gold being sucked out of London and sent to New York is people in America trying to restock the vaults because they looted those vaults already to get that gold and sell it or lend it. And so maybe they're trying to restock Fort Knox before Trump shows up. That would be pretty funny if he caught them in the middle of that process.
Well, John, I'm going to tell you, paying attention to you, I've done very well with your advice. I want to thank you for that. So for the average person, how can we get hold of you? You've got your Substack subscription still?
Yeah, I'm at rubino.substack.com, and it's a newsletter that looks for actionable advice based on the stuff that you and I just talked about. There's a lot of crises coming, a lot of big changes in capital flows and things like that. And so what do we do about that? How do we invest to get out in front of that stuff? And how do we change our lifestyles to get out in front of it? So yeah, so far so good.
Absolutely, positively. Anything else that you want to put on, John? We've been on here a long time, and I've taken a lot of your time.
No, I think we're good.
All right. John, thank you so very, very much for this. We'll put this up and people can see this, and I'll put your Substack on underneath the video so that they can get hold of you. And you offer a free newsletter, do you not? It's no charge for like a.
Yeah, a big part of what I publish is free, and the really specific investment advice kinds of stuff is behind a paywall, but everything else is free.
Sounds wonderful, John. Thank you so very much.
Thanks,
Bye-bye
Michael.
now. My best to you.
See ya.